And a big earnings report coming out from JPMorgan reporting blowout third quarter earnings, $3.59 billion, a sevenfold increase from the same period last year. And analysts are taking note, as well as investors. That stock is up about 4% in pre-market trading. Well, JPMorgan Chase is a key barometer for the health of U.S. banks, and we've got bank analyst David George of Robert W. Baird on the phone right now to give us his feedback. And David, great to have you with us.
Hi, good morning.
Okay, so I know these are blowout results, and in fact, investors seem to be really taking to these numbers, but I want to point out just some of the warning flags coming on in this report. The $1.4 billion allowance in loan losses, adding $2 billion in consumer credit reserves, a $500 million loss on spreads. Any of that, though, a sign to you that we may see worse quarters coming ahead for JPMorgan, or are these sustainable?
Well, I think, as it relates to the sustainability of these quarters' earnings, clearly the capital markets, namely both corporate private equity as well as the company's fixed income revenues, probably aren't necessarily sustainable. But as you said, at least from our perspective, it looks like JPMorgan threw a lot of those kind of excess revenues, excess earnings in the reserve. And as you mentioned, JPMorgan added $2 billion to the reserve, and the reserve is over 5.3%, which is by far the biggest in the banking industry as we sit here today.
And the fact that they're putting that much money in reserves and still reporting some pretty good bottom line numbers, does that tell you that their earnings can only accelerate from here then?
Yeah, that's right. I think that, again, this quarter, while some lines may not be sustainable, I think it does speak to the earnings power of JPMorgan through the cycle. And as you mentioned, I think it's unlikely that JPMorgan is going to need to add to reserves forever. Credit is cyclical, so it will inevitably improve. And when it does, JPMorgan, we think, has among the better earnings powers, at least out of the large banks that we follow.
But they still are facing some headwinds, David. As you know, they're still increasing corporate bankruptcies. There's all that talk about commercial property and where that's going to go. I mean, how big of those are those headwinds for JP?
Well, yeah, that's right. We're of the opinion you're going to continue to see commercial loans and commercial real estate loans show incremental deterioration as we move through kind of the teeth of this credit cycle. Fortunately, JPMorgan is really underexposed to some of those categories. Commercial real estate, for example, is only 2 to 3% of loans at JPMorgan, so among the lowest actually in the banking industry. So if consumer turns first, which we think it will, JPMorgan, we think, will show an acceleration in earnings, at least relative to peers, as we go through the next 4 to 6 quarters or so.
And David, just want to throw out a number for you, because in the first 9 months of the year, 38% of JP's revenue went towards paying people, compensation. What does that tell you about how Jamie Dimon is managing the bank?
Well, at least in our opinion, management has managed this company very, very conservatively and not really on the quarter-to-quarter kind of basis. And this is really more of a long-term kind of value creation type of business model. Again, keep in mind, JPMorgan has really added to the company's earnings power and really benefited from this crisis because of the company's conservatism. Keep in mind, JPMorgan acquired both Bear Stearns and Washington Mutual at really deep discount prices. And when the economy inevitably improves, we expect that JPMorgan and JPMorgan shareholders are going to really benefit from a recovery in the economy, a recovery in JPMorgan's earnings, and again, the benefits from the great management that Jamie Dimon and his team have led this company through the cycle.
Okay, David, thanks so much for joining us on JPMorgan. David George of Robert W. Baird.